Renovating Retirement with Charlie Jewett. Oh no, I think I'm about to have another episode.
Jimbo, you there?
I am, man. How are you?
I'm good. Welcome back. It's the trifecta. It's like the Matrix. It's like Star Wars was originally. The Maze Runner. What else do we have with 3 movies in a row? Rocky's at like 97, so we can't use Rocky.
Yeah, we're on Creed, 2?
Creed 2 now. I don't know how they get so shredded for these movies. You see that? And his name's Michael Jordan, which is even weirder, right?
Right.
I don't know how they get in that kind of shape. I'm struggling to stay in just basic shape right now. I don't know about you. So this is episode 119 with Jim Carroll, third part to this trilogy with Jim Carroll. Today we're going to talk about some really exciting stuff. How to use other people's money, or maybe you call it leverage, or maybe I call it like a 3 times match, where a 401k might give you a 1 times match. This is a 3 times match. If you're putting $30,000 a year in, they're going to put in another. The way it works out, Jim, really, they're going to put in another, $90,000 a year. But how to use other people's money or leverage. And it's important to stop here because most people, to some degree, have been affected by the, like, debt is bad, borrowing money is bad, sort of what came out of the Depression with the old mortgage rules. And the reality is all the major institutions in the world, including the one you work with, believe debt is good if you're paying less interest than you're earning, right? That's called arbitrage.
It's called arbitrage, yeah. There we go.
And the best way to fit this into people's brains so they understand, we use an analogy, something they already understand, is just wholesale retail. It's been very, like, beat the horse to a pulp. What's the expression? Beat on a dead horse? Or what's that expression?
Yeah. You're not supposed to do it. Don't beat on a dead horse. Yeah.
It is very proven. Do we agree? We're coming up on Christmas time. Do we agree that buying things for a wholesale price, buying it for $10 and marking it up and selling it for 17 in your store, is a proven method of making a profit? Do we agree?
Agree.
Arbitrage is just the cousin or sister, and I don't know which one's older, but they're certainly both proven. Arbitrage, borrowing low, 2, 3, 4%, making a little bit more, 3, 4, 5%, is just as old, just as founded, and it's what every bank and every insurance company truly does. Jim, are you aware of any insurance company, Jim, that's trying to become debt-free like Dave Ramsey or Susan Orman says?
Of course not. I mean, they want to earn a 2% spread. That includes
spread.
Everything to run the open the doors, pay the employees, pay the commissions, everything that they do. The difference is they want to do it on billions of dollars and not hundreds of thousands of dollars. That's how they make lots of money.
There you go. And that's why I teach home equity planning. That's why I don't ever pay off mortgages. That's why I refinance my homes. That's why I teach retirees to sell homes and buy another one with the biggest mortgage they can and invest their equity. Because if you're borrowing at 3 or 4, today's probably 4, 4.5, and you're able to go make 5 or 6, you're doing what the insurance companies and banks are doing rather than what the banks are telling you to do. And I know I'm oversimplifying this, but isn't the basic insurance company model, whether it's whole life, universal life, indexed universal life, whatever, isn't the basic model, get someone to give you money, $100,000, put it into bonds and make 6%, keep 2, take 4% and either pay them, whole life, universal life, or buy options on a 1 or 2 year market for indexed universal life?
Correct. And then mutual companies just take whatever the investment is over what they made or their profit and reinvest it as dividends
and
back into the policy.
So we're basically talking about 2 giant industries who are screaming, actions speak louder than words, the insurance companies and the banks, which represent, giant, a huge part of the economy, right? 2 giant industries screaming from the top of their lungs, debt is good. You should be in debt as long as you're borrowing low and then earning high, which is just wholesale retail for loans, right?
It's contrary to what we were brought up. Good debt is good. Bad debt is not good. Consumer credit card debt is not good. Good debt is because you have good credit, because you can borrow money and use somebody else's money at a lower interest rate. That's okay. It's what financial institutions do every day. I mean, when I started thinking about this, and what I love about doing your podcast, Charlie, is your listeners probably think we go through all type of research and everything. You and I got on the phone before this 5 minutes and said, all right, here's what we're going to cover. Let's do it. I mean, we're not going back through and researching. This is just things that we do every day in our practice. So when I was thinking about it, I thought, the first podcast, we were going to talk about retiring with 100% of your income, making sure that at least on Friday, if you're making $75,000, $85,000 on Monday, when you retire, you're still going to make at least that amount. and have it be able to increase with inflation. The second one was to retire as tax-free as possible. We can't change what you've done, things in the rearview mirror. Charlie's got a number of ways he can help, but can't get rid of all of it, especially if you have pensions and things of this nature. But to try to retire as tax-free as possible. And then I think the theme of everything that we talked about with tax-free is, do you want to pay taxes today or tomorrow? They're at the lowest possible point they've ever been in our lifetimes. And we've got $20 trillion in debt. It's doubled over the last 8 years. If it doubles again in 8 years, it goes to $40 trillion. Do you think when the sunset provision steps in and taxes go back to where they were, they'll just stop at where they were, or there'll probably be more? If you believe they're going to be more, you want to go ahead and do something today. Do something today towards retirement, lock in those taxes. And then probably one of the biggest things, if anybody's listening to any of your podcasts, I'm going to ask you to do it one more time because it's like tying your shoes. What are your 5 lives?
Long life, short life, rough life, sick life, and into the next life. It's just my version of saying a financial plan shouldn't be stocks, bonds, and mutual funds, crossing our fingers saying, I hope it works out. A financial plan should be like having a spare tire in your trunk. I pay extra gas to take it around for that one time. Like the other day when I was swerving away I was going to hit a rock and there were 2 motorcycle cops coming up on the other lane. And I'm like, if I hit this rock and it flies up and hits a motorcycle cop, they're going to get injured and I'm going to get in trouble, right? So I swerved, Jim. You don't know the story. I swerved away from the rock that was near my left tire and ended up hitting a bigger rock with my right tire, popped it instantly, wow. And then used my spare. And I haven't used my spare in 4 or 5 years, but I pay the extra gas to tug that thing around all the time. We don't know, and our listeners don't know when you enter retirement. Are you going to have a long life, live to 110, 15, need income? Short life, one of you dies, the other person needs to be protected or have income. Rough life, emergencies, short life or sick life. You need to go into a nursing home because you have Alzheimer's. You got to pay $8,000, $9,000 a month for 2 or 3 years. And then finally, as you move into the next life, you're going to leave an inheritance. A good financial plan is not cross your fingers and hope the stocks go up. It's make sure no matter what happens, any of the 5 lives, you're good.
And if they learn nothing more than that and use that as the basis of the financial plan, I know I got some laughs out of this, but it's true. When you walk people into your home, you don't say, hey, look at my foundation, how beautiful it is and how strong it is. Man, it's post-tension and look how these footings were. You just don't do that. They come and look at your house and say, oh, this is beautiful. I love your furniture. I love your counters. But without a good foundation, that house will crumble. It will fall apart. It's just well-laid intentions don't work unless you have a strong foundation. And so when we're looking at premium finance or leveraging for retirement, what would you say, and this I'm putting you on the spot here, what would you say the average age of your listener is?
I think the average age of my listener and the average age of my clients, the people that actually come and get in touch, are maybe different. But from starting the show 2.5 years ago, I think the average age of the listener is probably 45 to 50.
Okay. So I did really good here because I guessed based off what your clientele has been with us. I looked at a 45-year-old making $250,000 per year, knowing that Social Security is going to decrease at least substantially. It'll go down to 77% of every dollar promised.
So you're being conservative. You're going to assume they don't snap their fingers like they did last time and fix it 3 months before running out of money. You're just being conservative and saying, what if it drops, right?
Well, yeah. If you read your Social Security statement, it says it will drop unless something's done differently. So you're going to go from, receiving at least maybe 25% down to only 11% of what you would have received. That's just a statistical number.
Yep.
The average 45-year-old, if they've done a 401k, we've talked about the tax time bomb. They've created this profit-sharing plan with the government where the government gets to take what percentage they choose first and you get what's left over. It's not really a great plan, but it is a plan.
Yeah.
And most people have done well with that. And I think we talked about it last time. You and I are in agreement that people should do 401k if there's a match because that's free money. It's for every dollar you put in, they'll match it up to a certain percent. 5%, whatever it is, 3%. You've got to do that. You can't step over $100 bills and leave them on the sidewalk. But everything over the match, you should redirect, even at 45, into a tax-free retirement plan. And what do I mean by that? Well, if you have only done, and if you were diligent and did 8,500 or the max that you could do every year, you're still not going to have enough to get you back to 250. There's just no possible way.
Right.
Even with phenomenal returns, you can't do it. And so a 45-year-old at $250,000 per year has to do a couple of things. Number one, they should be saving about $85,000 a year to be able to walk back into a $250,000 income when they retire at 5% return, all the way up to, man, I always do it to 100. I mean, I'm an optimist. I knew I should have taken better care of myself when I was younger, but I feel like if the average life expectancy for a male is 75, I can beat that. I just, that's my thought. So I want to do it to 100. The other thing I have to look at is, if I become ill, it's one of the lives you talk about, what's going to cover that, and what do I have to take care of that? Now, I got great benefits now, but when I retire, what's going to happen to my benefits?
Yeah.
And then last but not least is, I still have I have a 25-year-old, a 24-year-old. The 25-year-old is about to be 26. They're 20 months apart, and a 17-year-old. I was reminded this weekend when my son came home for Thanksgiving that he needed new brakes. He needed a new headlight, and the oil changed. Oh, and by the way, one of the tires was going bad, and he probably is going to need a new tire. And so, $900 into this Thanksgiving trip home, it was like, aren't you glad I didn't fly home, Dad? It's still, you're responsible for them. So for every $50,000 in income.
Wait. What? I'm trying to just get him in college and stop paying. I thought I was over at that point. It's not over at that point?
Never. It's,
there goes my plans to retire.
It's just better because it's not as bad. They're paying their own rent. They're doing those things. But you know what? As a father, it's one of those things.
It's a joy, right?
It is. You know what?
Joy.
I just want to thank you. They don't come out as fast. They kind of expect it. But, my kids are pretty good kids. Two of them already completed college. One's getting his PhD, and the other's about to graduate from high school. So life is good.
You got it piled high and deep in there, huh? That's nice.
So, but the bad thing about it is, if something happens to me, what happens? My wife says, stay-at-home mom. I always tell people I get to go to work. She stays at work, and she has done that for 25 years.
Yeah. That's nice. We say it again. You get to go to work, which means you get to come home from work and leave it. She stays at work all the time.
Absolutely. I mean, that's what being a full-time mom is. They get calls. They get all the stuff. I'm out of town. I get to go to work. I get to hang out with the Charlie.
Who's got the harder job? Exactly.
Everything else,
It's you and I out drinking a beer or going to a training, having fun, learning. Well, who's got the harder job? Do you think the stay-at-home mom or the working, traveling man?
Not even a question. I love my job. I know my wife loves her family too, but it's the toughest job in the world.
Every man's got that experience where the woman finally does something for herself and goes to a girl's weekend or a girl's vacation, is going for 5 or 6 days, and you got all the kids, and you're like, oh my G. Right?
And you try to act like it was really easy.
It's like who's that? Steve Martin did the Cheaper by the Dozen.
Yeah.
Right? And was left with the 12 kids, and I got this. And they're like killing each other and burning stuff.
So the bad part is, if I orphan my family, I have to have, for every $50,000 in income, at least $1 million in death benefit.
Exactly.
And the reason why is, if I'm only going to earn 5%, and that's pretty reasonable right now, then for $250,000 in my example, I'd have to have at least $5 million. How many people do you know that have $5 million in death benefit?
Did we plan this? Did we talk about this before we started recording?
Absolutely not. That's why I love this. This is just natural numbers that I use every day.
On the podcast, there's podcasts, previous podcasts to see how much life insurance should you have. But what I've always taught everybody is the most conservative thing you can do. Forget like paying off your mortgage and all that kind of stuff. The most conservative thing you can do, which is why I have the amount of life insurance I have, is just say, what am I making in income? Divide it by 0.05. And say that's the chunk of money that would need to be kicking off a 5% rate of return to replace my annual income. And we're not even talking about covering raises or inflation, right?
No, that's just covering the nut.
That's just covering the nut. And that's why I'm not a giant term insurance guy, because I use life insurance and annuities instead of stocks, bonds, and mutual funds for the most part, right? So I'm more of a guy that says, let's fix your retirement plan and your growth plan, your in-case income increase, and then see how much death benefit you got, picked up along the way. It's coming along for the ride. Go back and say, what about short life? What if I passed away? Is there enough of a death benefit to replace my spouse's income, or did I set up annuities that are going to do it anyway? But the way you solve that, the way you go, no, if I died or if she died or he died, the problem, if there's a decrease in income, because we know there's going to be a decrease in Social Security, one of them goes away, and then you all of a sudden become, after 2 years of being a widow, you become a single taxpayer, so you're paying more tax on less income, right?
Right.
You know there's going to be an income reduction. When after all the planning is done, and we say short life doesn't look good, that's where cheap term insurance, it doesn't matter whether 2% of the people die and the insurance company wins 98%. That doesn't matter. It's sleeping at night knowing you're going to be okay. That's where the term insurance, just a straight purchase, I'm going to sacrifice a gift of love to make sure that my family is going to be okay, comes into play.
Well, again, and we talked about buying term and invest the difference. What was the big problem there?
Nobody
People
does
don't
it.
invest the difference. It just doesn't happen. And most people, you just gave the percentage, die after the term.
And most people don't know this, but E.F. Hutton, the group E.F. Hutton, and tell me if I'm wrong, if it's some other group, I think he was dead at the time, but the group E.F. Hutton, I knew one of the guys that was on the team that created universal life insurance. Universal life insurance, instead of whole life, was actually created to be annual renewable term, and then the difference is invested for you. It is by term, invest the difference for the rest of your life, isn't it?
It is. It's just a managed account by the insurance company.
Right. And it's misunderstood because universal life, the basic universal life, not index universal life, but basic universal life that came out in the late 70s or 80s, there was a mistake made by agents, which my listeners won't be surprised that agents lie and screw up, right? That's the whole Financial Malpractice 1, Financial Malpractice 2 episodes. Agents were running illustrations at 80s-like returns. It's 15, 16, 17, 18%, saying you're going to be great. And when those percentages came back to normal and the insurance companies called and said, you have to pay into this policy or it's going to lapse, Universal Life got a black eye. But that's kind of like saying, do musicians make money or not? Well, which musician? Taylor Swift or the guy that was down at the cafe, right?
Right.
It's bad universal life policies or bad life insurance policies don't. Great universal life policies work like, they perform like Taylor Swift, Billy Joel, and Elton John.
And the beauty of it is now there's restrictions. You can't illustrate those. You have minimum required interest rates that you have to show. You have guarantees. And you even on your company illustration, it cannot be over a certain amount. And so there's some governmental things that have stepped in and said, hey, look, you can't misrepresent what this is. It is what it is. Here's what it's supposed to do. What's the guarantee and what's it reasonably going to do?
I'm going to be annoying today. I'm going to stop you like a million times, okay?
That's okay.
Because this is a very raw podcast episode. Tell me if this is a reality. When I got my Series 65 license and I studied securities, it was taught to me that it used to be that joker brokers, the way I call them, stockbrokers, could show 12% compound annual returns. And the SEC finally stood up and said, that's not right. It's just not the way money grows. And said the most you can show is 10. And I don't know if they've changed it since then, but back when I was doing this, it was the SEC said you could show 10% compound returns on your hypothetical illustrations. In the insurance world, policies like your company have actually done better, 7, 8, 9% than what we're even allowed to show. And they passed a law for conservative people like us, or conservative strategies, life insurance. They passed a law that says you're not even allowed to show what it's actually made. So what we really have, the aggressive guys are allowed to show more than what it's actually made. And then the conservative guys or the tax-free guys have to show less than it's actually made. Do you agree with that?
It is. And if you look at my personal policy over the last 5 years, I've had double-digit returns. the lowest being 11%. But the most I can illustrate right now is 5.88.
Unbelievable. That's unbelievable. And it's good.
I know that in a 10-year period, I'm going to have at least 2, maybe 3 bad years, which will average that out. But because it's an index universal life, I know that I'll take all the good years I can get, because that 0 is really my hero. Because when it goes down 12, 15, 20%, I don't lose that money, and I don't have to regain it the next year, because it's an annual reset. It starts over each year.
For our listeners, over a 20, 30-year period, making 6 or 11 and 12, right? That doesn't mean you get, like, if you're making 12 instead of 6, you're not getting twice as much money over a 20 or 30-year period. You're getting 4 to 8 times as much money, right?
Correct.
Compound interest is the eighth wonder of the world. Every 1 or 2 percentage points you can put in there, compounding every year is going to exponentially increase whether you can take an income or run. Basically, it's the difference between running out of money before you die or living the life of your dreams and leaving a huge inheritance to charities or loved ones.
So there we go. We've covered short life and long life. Then the other life that I want to talk about is what happens if you become ill, sick life. The average person retiring today will have a 70% chance of needing some type of long-term care service.
And do you agree that before, I told you I was going to interrupt you a lot, it's just my mood.
That's okay.
You agree that before accelerated benefits, when it was just traditional buying the long-term care policy, which pretty much everybody was emotionally resistant to, right? But do you agree that before the addition of accelerated death benefits, the industry really didn't have any good answer for this problem of you're going to get sick, or 70% of you are going to get sick, or you have a 70% chance of getting sick, and the cost is like $8,000 or $9,000 a month for 2.3 years or whatever.
And it goes up every 5 years. If you buy long-term care, it's expensive. And every 5 years you get older, it goes up even more. And then when you need it most, you can't afford it.
I've seen 85% increases in monthly premium from long-term care companies before the person's even gotten sick or known they're even going to use it.
And remember, living benefits, it's not long-term care. What it's actually doing, if you become critically, chronically, terminally ill, or critically injured, they're accelerating your death benefit. If I have $1 million in death benefit and I need $100,000 to go into rehab, I've had a stroke, I need to go into rehab, I need that to live off of in order to pay my bills and get better. I have insurance that's just going to pay out of pocket. Instead of having $1 million in life insurance when I go back to work, I'll only have $900,000. And so it's not getting something for free. I'm not paying any additional for it. I'm just using my death benefit while I'm living.
Well, let's put it in put it into an analogy, right? Where something that people can understand. If you have $1 million sitting in the bank and you don't spend it, so you've saved it up and you don't spend it, and you die, your family can have the entire $1 million. Agreed?
Yes.
If you don't have $1 million in the bank, but you want your family to receive $1 million, the very basic existence of life insurance companies is they say, we'll give your family $1 million when you die, but you have to pay us X amount per month or per year. That's just the super basic. You can buy $1 million at your death. You can leave an inheritance or have someone else leave an inheritance to your kids for some price. Is that agreed?
It is. I mean, you're leveraging or outsourcing the risk.
Right. And so all you're saying with accelerated death benefits is this isn't long-term care, but just like if you had $1 million in the bank and you said, I want to leave it to my kids if I don't need it, but then all of a sudden you need it and you have to spend $8,000 a month for 10 months, you spend $80,000 of it, or 20 months, you spend $160,000 of it, you're going to leave less of it to them. You either use it while you're alive or you leave it to loved ones. You guys have just created life insurance policies where the death benefit functions exactly like any other asset that says, you know what? If you need it while you're alive for these reasons related to sickness and long-term care and nursing home expenses and alternative medicine, you just spend the death benefit that you've been paying for. And then when you pass away, there's just less available to your family, just like if you didn't need to use us and you had saved the money up in the bank, right?
You know, at National Life, we say it's life insurance you don't have to die to use. And so that's the big difference. The second thing that really is a big deal is, what is the biggest fear of anyone over 50? It's going into a nursing home.
Yeah, either going to a nursing home or running out of money. Those are the two big ones I use.
Exactly. But the nursing home is the scariest because less than 36 months life expectancy when you go into a nursing home. That's the average life expectancy, less than that. So it's a place they put you out to die. I'd rather live in my home and have it as, in-home health care, or go to the assisted living. We talked about it last time, the country club where they have everything covered, but I do have some help if I can't do 2 of the 6 acts of daily living.
Going to a nursing home is truly when you're over the hill. Like, it's downhill from there, right?
Well, they're putting you there to die. It's pretty morbid, but it is what it is. And so those are the 2 things. Again, the last one, or the third one with the original, is if I'm terminally ill. Well, why would you want to accelerate a death benefit if you're terminally ill? Well, I've got 2 great examples that are true life examples. One, the obvious, if I have a type of cancer that's, they give me 18 months here and there's no known cure, but my doctor says in Brazil, they have a 54% success ratio with this experimental treatment. And over in Paris, they have 72%. I'm on a next flight to Paris.
Yeah.
And I'm going to spend I'm going to at least give it a shot. I want to live.
Can people pay for the flights with the money from your policies?
It's their money. They can do anything. And it's tax-free because it's an accelerated death benefit. No restrictions. You just have to be diagnosed by a licensed physician.
People don't know, you and I, this is old hat for us, but is that the way a long-term care policy works?
Not at all. There's specified things that you can spend it on. It's just very restrictive.
I mean, you and I have a
much more restrictive.
You and I have a dear friend whose wife had a major breast cancer scare.
Oh yeah,
and had a policy with you. I don't know. It was only like $400 a month or whatever. But how much were you going to accelerate or give her to fly to Paris or go wherever she could find the best cancer treatment in the world?
It's like $485,000 out of $500,000.
That's nuts. For paying $400 or $500 a month or whatever. To be able to accelerate, $400,000 or $500,000 to pay for the best care you can find, no matter where it is on the planet, and use it to pay for travel. There's no long-term care that does that.
Oh, even if it was just a critical illness, and again, she wasn't diagnosed as terminal, it was just critical. It was potentially cancer. They had to go in. If it was cancer, she was going to have to do radiation, chemotherapy. She was going to have both breasts removed and then reconstruction. Well, guess what? There's a lot of out-of-pocket in that. And that would have all been covered. Plus, if she didn't have disability and had to stay out of work for at least a year, that's all covered. You can accelerate that death benefit.
Yeah. Here's what's funny about you and I. I don't know how many minutes we are into this. We haven't talked at all about what the show's about.
We're getting there. So that's one of the things I wanted to talk about. The last one is critical injury, and the same thing there is if you're critically injured, there's long-term rehab. Head injuries, fire, burns, things of this nature.
You guys said there's something that you added for like firemen, police,
firefighters.
Like a big deal, right? Tell me about that.
Well, it's critical injury. If you are burned, which is long-term rehab, if you have some type of a head injury or things that could happen on the job, if you're shot and have certain things happen, you can use this. And so we really went after our hometown heroes, the people that are every day out there protecting and serving, to try to have something in there for them, because it's hard for them to get benefits. It's very difficult because they're in the line of fire every day and people don't realize that. It's easy to bash them, but who do you call when your house is getting broken into? You dial 911.
Yeah.
And so, that's one of our ways of giving back. So those are the 4 benefits, living benefits. But when I look at this, the real reason is, we know that taxes are going to be high. We know that things are going to be there. Why would you do premium finance? Why would you finance your premium? So what are the things that in your lifetime, Charlie, that you financed? Do you ever finance a home?
Yeah. So the listeners may know this, I've had 15 homes. It was on purpose. Wow. I was buying and flipping in San Diego when if you bought before it was built and then you sold it after it was built, you'd make $50,000 to $100,000 right away, and only took $3,000 to $5,000 down payment to lock it in. And frankly, it was up so much when it was finished. If you wanted to bail, they'd happily just forgive the $3,000 to $5,000 because they were going to make the 50 to 100 grand, right?
Right.
So I did some flipping. I did some when my kids were young and it didn't affect them. We did some, move into a home for 3 months, and then buy another one so we could do owner-occupied financing on everything. So we did 15 homes in first 9 years of my marriage to my ex-wife, right? My personal opinion, when I learned this from you, is the greatest analogy to put this inside of people's minds is the mortgage. And you can talk about other things you finance, but we all live greater lives, much, much better, a higher quality of life in the United States because of the ability to borrow money. We live in houses we could never afford because we borrow it at favorable interest rates, and it is worth it. All we're talking about with premium finance or this leverage idea is that banks don't care what they lend you money on. They want to make their 4 or 5%. Banks will actually lend you money to put money into tax-free retirement income, and they make 4 or 5% while you're making 6 or 7.
They don't care. Same thing. We buy bigger, better cars than we need, bigger, better boats, vacation homes. These are all things that we don't have enough money in our bank account, but we have the credit worthiness and the income in order to make a payment on that. So banks have said, we don't care what it is, as long as you have the credit worthiness and the ability to repay it, we will loan you money on that.
Right.
Thus, we have premium finance. So what did I tell you at $250,000 annual income you needed in death benefit? $5 million. How does someone get $5 million? Well, you either can afford to pay for it at 45, which means you're doing pretty well,
right,
or you finance it. And when you finance it, what you're doing is you're going out to a bank and saying, hey, I want to borrow this money. You're going to an insurance company saying, I'm healthy. I want to get life insurance. So it's really two separate transactions. What we do as an insurance company is partner with third-party administrators that will do both. They will do the loan and underwriting all together along through, just putting everything together as a package that makes it work. And so when you look at this, it's really leveraging your money. It gives you, when you do this, 60% more income when you retire and 50% more protection for the same dollar. And that's at the guarantee. If we got into the illustrated rate, that number just goes up. And so you're really looking at...
You and I just talked about the illustrated rate isn't even what they've made.
Oh, no.
Not even close, right?
That's it. No way. Not even close. We illustrate 5.88, and I got 11 last year.
So the one analogy to help people go, what is this in their brain? You pick something that they already know, right? That's what analogies do. It's a mortgage. You're mortgaging your retirement. That's it, right?
That's it.
So you get a much, much greater retirement to the tune of 60, 70% more income if we're talking about the guarantees, 100 to 200% better retirement income if you're talking about the illustrated rate or what it's actually earned. The other way to look at this is what people already understand, Jim, is a 401k match. So if some people say, I put in up to $18,500 a year, imagine, this would be amazing, but imagine that their company had 100% match up to that percentage. They put in $18,500. What does their company put in for them?
Well, whatever the match is. So up to, if it's a 5% match, they put into it up to that amount of their salary.
Exactly. So if it's just in my fake scenario, if they do $18,500 and the company's matching enough to do that, the company's going to put another $18,500 in. So basically that's double premium, right? Or double contribution. Do we agree?
Dollar for dollar.
The way that premium finance actually works out, I know it's not all year for year, but isn't it basically if you put in, $30,000 for 5 years, they'll do another 30 in the first 5 years and then 60,000 for the next 5 years. Isn't it basically 3 times extra money or a 4 times match?
I'm using an exact example, and the reason why I picked a 45-year-old is I had an illustration. This individual was going to do $50,000 a year into the policy. That got him a little over $1.5 million in death benefit. So as he put in $50,000, the bank put in $50,000, so it's $100,000. And they did that for 5 years. At the end of 5 years, he no longer had to contribute. He was finished. The next 5 years, the bank put in the entire $100,000. That not only what they were putting in, but an additional $50 for 5 years. At the end of that 5 years, this money has gone into an accumulation account, a growth account. You borrowed it at a certain rate, depending on the company, but it's like prime plus 1 or prime plus 1.5, or the Moody's long-term bond rate plus 1.5.
Right.
So a fair rate, very fair rate. The beauty is the next 5 years, you let the cash value pay the loan off. If you die and you borrowed $300,000, you've got $1.5 million. The company, the bank, gets theirs first. So they're going to take $300,000 out. You've got 1.2 to go to your beneficiary, and you're good. But if you get past that 10th year, from 11 to 15, the cash value pays off that loan. And then you're able, from the 15th year on, to use that as cash, tax-free income.
So we're not even talking about a 30-year loan. We're talking about a 15.
That's it.
Somebody will lend you money for 15 years to crank up and put your retirement plan on steroids. And then they pay themselves back from the policy itself, from the money they've been giving you and what it's grown to. And then you're out. You don't know anything, right?
And do you know what the stress test is on that? They use the Great Depression. Would this have worked in the Great Depression? And if the answer is yes, it works. If it's no, then it says, hey, we need more premium. And so to me, that's the ultimate stress test. It's the worst that our country's ever been in.
Because we didn't even have that in 2008 and 9.
Oh, no. Not even close.
And that was abnormal. That's not like an app, that happens every now and then. It's not even that. That was pretty abnormal.
So what most people ask is, okay, so what's the catch? There is no catch. The catch is you have to leave it in there 15 years, and you probably want to leave it in there longer. We get the eighth wonder of the world, the miracle of compound interest, and it just builds it up. So if I'm 45 and I want to, at 65, start taking income, that's 20 years. So what happens when I've paid my $50,000 for 5 years and I've stopped? I stack it. I do another one.
Yeah.
I do the same thing over. I tell them I'll do another $50,000 for 5 years. Will you match it?
Multiple policies, right?
Absolutely.
And this is not like a young person's strategy. Like if somebody's 60, 70, whatever, they still have the long life problem. What if I live a long time? Or they've got the issue of, I want to crank up my death benefit and buy a lot more death benefit than I could possibly do. Because doesn't it increase the death benefit as well?
Oh, yes. It's much more. So you're getting 90% more cash value. And if you look at it, you're getting probably 3 times to 4 times the death benefit.
So it sounds like we're just talking about efficiency. If you have premium, or if you have money you're putting towards these 5 lives, and you can get 2 to 4 times more income and death benefit for the same exact premium, what would be the reason someone wouldn't do that?
Well, number one, they couldn't afford it. They couldn't qualify.
You got to have what, 20, 30,000 a year, or what's it?
A 45-year-old had to have 50. So, I mean, it really depends on your age. You see people anywhere from 35 to 60 doing premium finance. If they're over 60, they're usually wealthy and taking care of a tax problem. They're going ahead and paying the taxes early for their family at a certain tax rate. They know it's lower because they can leverage it, buy more death benefit, which i.e. in turn pays the estate tax. But for the younger people, it's just a strategy and that's why they used to not be able to do it, is because companies didn't package it the way they have now. You had to be extremely wealthy. This is for somebody making $250,000 a year. I still consider that just a little above average American.
Now you have solutions for people down to like 100, 150, right?
Correct.
So if you're between the two partners, if you're a dual income family, right? If you're making 100 or 150, we can at least begin having this conversation about borrowing money to put your retirement plan on steroids. And there's kind of 2 options, if I understand correctly. There's a way that you guarantee it, you collateralize it for a while with your other assets and maybe get higher returns. And that would be like stellar, like shoot for the stars. Or you have an amazing retirement, not the absolute best available, but you have the next level down, which is better than every other retirement. And you don't have to collateralize anything. Is that right?
That's it. And on this strategy, there is no collateralization.
It's just crazy. That's unheard of in the so the listeners know I'm at 14 years of doing this, and the reason I never did premium finance is because you had to be worth $5 million and up, and you had to collateralize it yourself, and it took a long time, and blah blah blah. And I'm working with like regular families, people that had, and you can be rich, and my strategies work. That's fine, but I grew up poor. My heart was for people that were kind of basic, normal, middle-income folks or whatever. I've got some rich clients, got some super poor clients, but my bread and butter has always been the person, 500,000 to 2, 3, 4 million, just sort of the basic, I have enough to retire, and what do we do with it, and I can't make mistakes. And this was like 5 million and up, and like the first 20 people I talked to who were rich were kind of boogers, and I didn't like them. Right? They were arrogant. But now we're into like normal folks. If you're making $100,000 to $150,000 a year between the two of you, in a lot of states, you kind of need to. That's a lot of people right now.
Yeah, it's amazing. We're working on a program right now just for administrators for schools. And it's because never in the history of premium finance have they been even thought of. But now,
right.
If a joint couple, husband and wife, can make $100,000, $150,000, depending on how big the group is, they can actually do premium finance. So you get a 35-year-old. How would they be able to do this? Well, they're doing right now, that's going to go up to $19,000 per year next year into a 401k. They're going to do their match up to, let's say, 3%. What they need to do is take everything from above that 3% and set it over into a tax-free retirement account.
Right.
They need to make sure if they have dead money, i.e. a tax refund, put it over there. If they're in consumer debt, move that over. You're going to get $20,000 to $25,000 easy into an account, and you have not changed your take-home pay one bit.
Right.
That goes back to our first podcast of how do you retire with 100% of your income without changing your take-home pay.
Yeah.
That's why we had to talk about that strategy first, because it led to the Christmas present of premium finance.
Yeah. Hey, if everybody understands like leveraging a mortgage or a 401k match, and we're just teaching them another way that banks will do that for you. Forget whether it's a bank or an employer. If somebody will give you extra money, that's better for you. Agreed?
Absolutely.
That's all we're talking about. So get in touch, Charlie at jewettwealth.com, CHARLIE, at JEWETTwealth.com, CHARLIE at JEWETTwealth.com, or just call us, 888-285-2268. That's all we're talking about is for many of you. I mean, Jim, before I learned this, because we only know what we know, I had tons of people doing $20,000 to $40,000 a year into, tax-free retirement without doing the leverage, right?
Oh, yeah.
And I can't be accountable for what I don't know, but once I know something, I need to apply it and teach my people, my listeners, my followers, and my clients. I told you today would be a bit of a raw episode. What you don't know, if you don't mind, can I finish with the story?
Sure.
I received a phone call this morning that one of my favorite clients died. And it's rough.
It's never a good call.
No. And she couldn't get into his phone to tell anybody. So she asked me to, tell some people, which is hard, right?
Well, it's hard because you become personal with your clients.
I become personal, and he didn't have this type of money necessarily. He had mostly 401ks and things like that were already sort of tied up in this is like the rawest show imaginable. I'm crying and I'm cooking onions because I'm making a chicken pot pie and I'm out of time. But that's how
now you're making excuses for it. There we go.
That's how my podcast. Oh, it's the onions. Yeah, it's the onions. It's not the death of the. It's not that. It's the onions. But this is the only person I've ever retired at 57 years old and told to live off of their retirement accounts before 59 and a half. If you're living off of retirement accounts, you have an extra penalty for the federal for 10%, right?
Premature tax penalty.
You have the penalty, and then California tax on another one. It's a California client tax on another 2.5%, so he's paying 12.5% penalties. But the reason I gave him that recommendation, Jim, was he said, I've been turning wrenches for the gas and electric company for 30 years, and my arms are giving out on me. And, Charlie, this is when he was 57 years old, he said, and my mom is sick. I don't know how long she's going to live. And he lives on an Indian reservation. Beautiful man. Family's important to him. And I said, buddy, paying a penalty is just a choice. It's just a thing. You decide that, right? But If you lost your arms, if you worked another 2.5 years and didn't have the use of your arms or had pain for the rest of your life, what price are we going to put on that? More importantly, if your mother passes away while you're still working, trying to get to 59 and a half, you missed her last years, right? Long story short, Jim, he listens to me because we even went and figured out what part-time job he'd need to get to cover the penalty he was going to pay. Does that make sense?
Yes.
And it was like 15 hours a week at $5 an hour. And minimum in California was like, back then was like 9 or 10, right? So I said, I think you're good to go. Let's preserve your arms and give you time with your mom. Fast forward. His mother, he got a year and a half, 2 years with his mother. She did die before he was 59 and a half, and he got time with her. I got to record him. I got to put him in my office and record him on video talking about his family. This is called legacy planning. His family and how he grew up and how he first learned about money and what his parents were like and what his parents taught him and what he thinks of family and what he wants everybody to know about him when he passes away. He preserved his arms. What nobody knew, and Jim, you'll have more stories than I do. I'm the one who's been crying all morning, right? We didn't know he was going to die.
You never know. That's why it's so important to have the plan. The 5 lives, you don't know which one of them is going to kick in first. You know that the ultimate is going to be there. We're all going to die. It's a matter of when, and if we do proper planning, it takes care of all 5 of those lives.
That's a proper financial plan takes care of you, whether you have a long life, short life, rough life, sick life, into the next life. And this guy, because he had jammed everything into 401ks at work, he didn't have that type of after-tax money. Maybe we could have done 72Ts and all that, but he needed the money. He needed the income right away, so we used annuities. But the point is, there's a lot of people out there that can do what you're talking about, and your way, they're going to have 2 to 4 times the death benefit, whether they need it to pay for nursing home care or whether they die suddenly like my friend whose spouse is going to be okay because we did continuing income on the annuities. But how much better if she just got a 2 to 4 times multiplier on the inheritance that he leaves her? Does that make sense?
Well, and the best analogy is how many people, and I'm not picking on it, but back when I first got married, I bought my wife a Hyundai. It was $99 a month. First car we ever bought together because I could afford it, right? I got to keep the car that my dad bought me. It was the used car. But the great thing about it was I had a car. And now she's got an SUV. She's got to haul kids. She's got all that stuff. Don't let your family be stuck with the Hyundai of life insurance policies because that's all you think you can afford. Yes. Remember, in securing the loan, there's no documents, no personal guarantees, no credit checks, no financial underwriting. It's, do you have an income of X amount, $150,000 a year? And then on the other hand, are you healthy enough to qualify for life insurance? If you hit those 2 qualifications, you can do premium finance. It's not just the wealthy. You don't have to drive a Hyundai. You can drive an SUV because that's what your family needs.
It's a lot like financing a car. Like if you had the money right now, you could get a Tesla, Cadillac, a Lamborghini, whatever. You just get it and finance it and go, no, it's worth it to me. The experience, the better life is worth it to me to pay some interest to somebody. It's the same exact thing, right?
Well, and in this, are you really paying interest? You're using other people's money and
it's arbitrage.
Yeah.
Like we want to
you're
pay
making money off their interest.
I say to people all the time, you hate debt. So if I showed up at your house and said, give me $1,000 every month, you would hate that, right? And they say, yes. And I say, what if I showed up every month on the 1st and said, give me $1,000. And as soon as they handed it to me, I gave them $1,200. I would say, how many days do you want me to come this month? And what do they say?
Can you come every other
Can you come twice
day?
a day?
Yeah, twice a day, every AM and PM.
No one hates debt. Everybody hates debt that costs them money. Everybody loves debt that makes them money. And that's what we're talking about, the good debt. We're not talking about credit cards where they reassess it daily at 19%. We're talking about an annual 4 or 5% inside of policies that you're saying from your experience, yours is made like 11 or up.
And it's going to do a 0. I know it is. It's going to have at least, historically 2 out of every 10 years, maybe
and
3 out of every 10 years.
Is zero bad in investments?
Zero's your hero.
Zero's your hero.
I don't lose money and I don't have to regain what was lost.
And when the market rebounds, you have every single dollar earning whatever it gives you the next year, where everybody else is recovering from a loss. Is that true?
That's correct.
So if you have $1 million account and you make zero one year, everybody else drops down to $600,000 or $700,000. And the next year, when the rich guys start to buy, when the mutual funds and the George Soros and the Warren Buffetts, when they start to buy when things are cheap, which is the definition of a market crash, things go on sale, and they drive that market up, not back to where it used to be, not a recovery, that takes 4, 5, 6 years. When they drive it up over a 1 year period, and you hit the maximum of 10 or 11% in your industry, or in your policy, you're making 10 or 11% on the entire $1 million or whatever your cash value is. Am I exaggerating, or is that true?
Well, it's the cash value, yeah. And now, I was extremely excited with 11. The market did 18. So, did I win? Yes, because had it done minus 18, I would have lost nothing. And at the end of the year, I lock in my profits every single year. And even if it's a zero, I lock that zero in. But the next year, I start from scratch. I don't have to regain anything, and it's just a year-to-year snapshot. I don't get the full market value, but I get what my cap or participation rate is that year. And
Yes.
That's why I was able to get anywhere from 14 to 11%, even though the market did more. But I never lost a dime.
Well, I could talk about this forever. You know that. I have to sign off for some other things that I got going on today. But basically, let's do a summary here. If the listeners, between the two of them, if they live with someone else and their joint income, if they're making between $100,000 and $150,000 a year or up, you can be loaded and do this because that's what it was designed for originally, right? Doctors, lawyers, right?
Absolutely.
If you have $100,000, $150,000 a year or more in income, and you are able to set aside, the $20,000 or $30,000, that kind of place where you get to, you say, I'm like, that's more than I'm even allowed to put into 401ks and IRAs and Roths and things like that, right?
Correct.
Or particularly for people who are hitting some sort of a limit on Roth contributions, right? If you're in that world, that situation, get in touch. Charlie@jewettwealth.com, CHARLIE@JEWETTwealth.com. You can call us, 888-285-2268. We can show you how to use banks that do this all day long. They're begging for people like you. That's all they want, is to do this more and more and more. They'll lend you the money to put into retirement. And what did you say? Very, very conservative. Give you 60, 70% more tax-free income?
Oh, yeah. And the one group that we use that's just got this turnkey, they use the LIBOR rate plus 1.75. So it's extremely competitive interest rates.
This isn't like credit card companies trying to rip you off.
Oh, no.
This is like banks that do mortgages, and they're like, how else can we earn that same low rate?
You said something interesting. It doesn't have to be individuals. If you have a physician's group or an attorney's group, if they have 15 or more in their group, they don't even have to go through underwriting.
You say it was guaranteed then, right? It's like there's no underwriting. It's just guaranteed coverage.
That's correct.
Crazy. All right. Anything else you want to say on this?
Man, Merry Christmas to everyone. I'm a little sad because this is the end of the trilogy, but I will think of something else to hopefully let Charlie back on the podcast with him.
We'll do a Hobbit episode where Lord of the Rings 3 is over, and we'll have to do the Hobbit, and then we'll just keep it going. Or
There we
Creed. We'll start Creed. All right, buddy. Love you. Thank you so much for sharing with my listeners. The listen. I look at the downloads. People are loving the show, and let's get as many people into 100% income as we can. Let's get as many people into tax-free income as we can. Let's get as many people as possible leveraging and getting that 60, 70% more income than you could do on your own by just simply partnering the way you do with a bank when you want a mortgage, or the way your 401k, your employer matches your 401k. Good enough, Jim?
Sounds good. Merry Christmas to everyone.
Thanks so much, man. Appreciate you.
Take care.
You people are the best. Bye-bye.
That's all, folks.